Chinese second quarter GDP growing at the slowest pace since 2020.
So China's GDP in the third quarter dipped essentially.
Now, the Chinese government is expecting the country's economy to slow down this year.
For decades, the world saw China as an unstoppable economic machine, but now the engine is sputtering. Yes, even 1.4 billion people can't keep exports booming forever. For over 20 years, China was the face of rapid growth. Factories roared, cities expanded overnight, and its economy became the world's second largest. But the story is changing fast. In the third quarter of 2025, China's GDP grew just 4.8%, its slowest pace in a year. And this isn't just a seasonal dip, it's a sign of something deeper. For years, export-driven growth masked growing weaknesses at home. Now, as global demand cools and foreign companies diversify, cracks are showing. Domestic spending is faltering, youth unemployment remains stubbornly high. The once booming property sector, once making up nearly 30% of China's GDP, is in freefall. This slowdown isn't just about numbers, it's about a model that's running out of steam. What happens when an economy built on cheap labor, real estate and exports hits a wall? Today we will break down the property crisis, weak consumer demand, trade tensions and deeper structural problems that are reshaping China's future. Do you think China can reinvent its economic model? Or is this the beginning of a long decline? Share your thoughts in the comments below. And before we continue, don't forget to hit like, subscribe and share this video so you don't miss what comes next. Seriously, a couple of your clicks will help our community to grow. For years, real estate was the beating heart of China's economic boom, accounting for nearly 30% of its GDP. New cities rose from empty fields, and millions invested their life savings into apartments they believed would only rise in value. But that foundation is now cracking.
When Beijing moved to limit excessive borrowing by developers, the house of cards began to collapse. Giants like Evergrande defaulted, shaking confidence across the entire sector. Property sales have plunged 7.6% so far this year, and real estate investment has tumbled 13.9%. That's not just a slowdown. It's a seismic shock to a pillar of growth. For ordinary families, homes are their main source of wealth. As property values fall, so does consumer confidence. Fewer people are buying, and new home sales are expected to drop even further in 2025 to 2026.
The ripple effects are huge. Fewer construction projects, millions of jobs at risk, weaker spending, and local governments losing crucial land sale revenues. The boom that once powered China's rise is now dragging it down, brick by brick. For years, China's massive population fueled not just factories, but shopping malls, restaurants, and travel industries. But now the country's domestic demand engine is stalling.
In September, retail sales rose just 3%, the weakest pace in 10 months, a sharp contrast to the double-digit rebounds once expected. Even the Golden Week holiday, usually a spending frenzy, turned out mildly disappointing. Why? Because millions of households are saving instead of spending. With the property market in freefall and job insecurity on the rise, Chinese consumers are tightening their wallets. Household savings remain at record highs, reflecting fear rather than confidence. This shift is already hurting businesses. Private investment fell 0.5% in the last quarter, signaling that both consumers and companies are holding back. Meanwhile, factories are producing more than people are buying, creating overcapacity and pushing prices downward. A classic deflationary pressure.
When people stop spending, growth loses its spark, and without strong domestic demand, China can't rely forever on exports to carry the weight. The question now is, can Beijing restore consumer confidence before the slowdown becomes normal? What do you think? For decades, China's factories supplied the world, from electronics and machinery to clothing and solar panels, but that dominance is under growing pressure.
In September, Chinese exports to the US plunged 27%, a dramatic drop for its single largest export destination. To keep its factories running, Beijing has shifted its focus toward Europe, Southeast Asia, and Africa, where exports have jumped between 14% and 56%. But this pivot comes with a cost. Competing in these markets often means slashing prices, which eats into company profits and leads to factory layoffs. Lower margins are squeezing manufacturers that once thrived on steady US demand. Meanwhile, tensions between Washington and Beijing are intensifying. With Donald Trump returning to the White House, tariffs and trade barriers are rising again, reigniting a trade war that already strained supply chains. Adding to the pressure, foreign direct investment into China has declined sharply, hitting its lowest levels in years.
Companies are diversifying production to other countries, eroding China's long-held role as the world's factory floor. The trade landscape that once fueled China's extraordinary rise is now rapidly shifting, forcing the country to navigate a more fragmented and hostile global economy. China's slowdown isn't just about property bubbles or weak spending, it's about deep structural time bombs. One of the biggest is demographics. The country is aging fast, I mean really fast.
After decades of the one-child policy, the workforce is shrinking while the number of retirees is surging. This means fewer workers, higher pension costs, and slower productivity growth. Then there's debt. China's total debt has climbed to more than 300% of GDP, severely limiting the government's ability to pump fresh stimulus into the economy. Every new boost risks piling on even more financial pressure. Under Xi Jinping, the economic model itself has shifted. Security and control now take priority over rapid liberalization. That has made foreign investors more cautious and domestic businesses more restrained. On top of that, overcapacity in key industries like electric vehicles, steel, and solar is creating massive inefficiencies. Companies produce more than the market can absorb, adding further strain. And hanging over it all is persistent deflation, with nominal GDP growth falling for 10 straight quarters.
These structural pressures make this slowdown not just painful, but hard to reverse. China's leaders are using the Communist Party's force plan to chart the country's economic path through 2030. The plan focuses on boosting domestic consumption, promoting technological innovation, and investing in infrastructure to reduce reliance on volatile exports.
To support these goals, the government announced 500 billion yuan in quasi-fiscal bank financing aimed at stimulating investment at the local level. Monetary policy is also expected to play a role. Economists anticipate modest interest rate cuts by China's central bank to encourage spending and borrowing, though any move is being weighed carefully against the country's already high debt levels. Balancing these priorities is a delicate task. Policymakers must maintain growth while managing a debt load exceeding 300% of GDP, addressing structural challenges like overcapacity, and keeping national security at the forefront of economic decision-making. Analysts are cautious about the results. Many expect China's GDP growth to settle around 4 to 4.5% in the coming years, slower than the heady double-digit rates of the past, but steady enough to navigate a complex, evolving economic landscape.
This plan marks a clear pivot. China is no longer chasing rapid growth at all costs, but seeking sustainable domestically driven expansion. The era of sky-high growth is over. After decades of double-digit GDP expansion fueled by exports and construction, China is entering a new phase. Slower, more balanced growth, but only if the reforms succeed. Risks remain significant. Persistent deflation, a struggling property sector, and weakening consumer confidence continue to weigh on the economy. Yet opportunities are emerging. Technological innovation, electric vehicle exports, and strategic infrastructure investment could help sustain growth and pivot the economy toward domestic-driven expansion. This transformation is less about shock and more about maturity, a shift from rapid accumulation to sustainable development. China rolls on exports and construction. Its future now depends on its people, policy decisions, and the ability to balance growth with long-term stability. What do you think? Can China reinvent its economic model and thrive in this new era? Don't forget to hit the like button, subscribe, and share this video so you won't miss our upcoming Global Myths Exposed series. The next one's brewing. Stay tuned.